Hi, I'm Sarah Zervos from Global Reach. I'm coming to you today from sunny and hot California to talk to you about a market that's not doing so hot, namely the U.S. corporate debt market. U.S. corporate debt are basically bonds issued by corporations when they borrow for their projects. U.S. corporate debt can be broadly divided into two groups. One is investment grade, the other is high yield. Investment grade bonds are those of higher quality. The companies will tend to pay you back because they're in better shape. The high yield group has another name called junk bonds, and as the name junk connotates, they tend to be the riskier group. That if things go awry or economy slips, these companies aren't in as strong financial shape and could have the probability of not paying you back. Well, so far in 2015, both investment grade and junk bonds aren't doing so great. In fact, prices have tended to fall and yields are going higher. Why, might you ask? Well, I think there are three main culprits. First, the economy is slowing. As economy slows, these businesses have less ability to generate cash flow. And that cash is what pays the bondholders back. So you can see a direct link between a slowing economy and higher risk in the company's debt market. Second, the Federal Reserve, is poised to hike interest rates. If you go back for the last few years, you'll remember that the Fed has kept interest rates very, very low in efforts to spur investors like you or I to take our money out of banks, out of cash, and put into other riskier assets, with the idea that as we do so, that investment will spur economic growth. Now the Fed is on the verge of raising heights. You could imagine the reverse flow could occur. Investors like you and I could end up taking our money out of those risky assets and cause prices to fall. Finally, in the last year, oil prices have been crushed. As part of the high yield market, a very large part of the high yield market is comprised of energy firms. It's unsurprising that the bond prices issued by those energy firms have also gone down quite dramatically. So what do we do now? Should we be looking to buy? Should we be looking to sell? Well, I'm not so interested in high yield bonds, but I still think investment grade bonds are safe. The last few times you might say the Fed has backed off of its interest rate hikes and high yield bonds have done just fine. This time I think is different. First, I think the Fed is pretty committed to hiking, but second, let's say that the economy worsens and the Fed decides not to hike. They don't have a lot of tools left in the monetary policy sphere in order to stimulate economy. Now, if you believe in unicorns, you could be relying on Congress to do something and initiate some sort of fiscal stimulus program, but I don't think that's very likely. As such, I think that while my base case scenario is the economy is going to be okay, the downside scenario would be that these high yield bonds suffer further. So where does that leave us? Well, I think the economy is doing pretty well and definitely well enough for investment grade bonds to perform. So I would keep my money in those investment grade bonds, and specifically, if you can have ones with less interest rate risk, meaning shorter maturity, you'll be able to insulate yourself from a possible Fed rate hike as well.